This is Will McCauley with cEntellect. I'm discussing this week's proprietary research and analysis report on United States crude storage, stock levels, and the impact on price and volatility of changes in stocks. So the question that we've been talking about recently is, do declining stocks in the United States cause increasing prices and increasing volatility? And the answer was a little bit surprising versus what we thought the answer was going to be going into the conversation. So we're going to look in detail at three main topics. The first is crude storage in the United States by region, a history of where it's gone and where we are currently, and our estimation of what is the operational storage level at various pads versus the merchant storage capacity at those same places, and how close we are to being operational only in certain storage locations. The second thing that we're going to look at is really the relationship between stocks, the price of crude, and the volatility seen in the market over time. And then the final thing that we're going to look at is a number of different scenarios in terms of high crude stocks, high crude prices versus high crude stocks and low crude prices, and vice versa, and what that means for potential near-term volatility in the crude market as we potentially transition from a high stock, high merchant storage scenario to a low stock, low merchant storage scenario. Surprisingly, I think the answer is actually no. Falling stocks do cause increases in prices, but they actually cause declines in volatility. And we'll get into much more detail as we go through the report. I'm going to hand over now to Mike Reed to walk us through all of those things that we just talked about and give us the detail behind the analysis that has been conducted. Mike, take us away.
Will, thank you. As Will mentioned, this is interesting. We're going to walk through how we got to the answer. I want to start with the first slide here. This is Cushing. Cushing is essentially at its operational level. We can withdraw maybe another 2 million barrels, and I really see Cushing flatlining at operational levels only. The reason we separate operational from merchant storage is when we define low stocks, we're not defining low stocks in terms of merchant versus operational. We're only defining low or high stocks relative to merchant, because crude storage levels really don't fall into the operational category. Operational storage is required for operators or refiners and shippers for blending purpose and to meet shipping schedules and so forth. So this is really the bare minimum. Cushing is almost there. And so we're going to focus on what happens to Cushing price in this scenario and Cushing price volatility. Also, Cushing is the delivery point for the WTI futures contracts, so it's pertinent to do so. Let's look at the entire U.S. as a whole. We've got about 300 million barrels of operational storage, about 600 million barrels of total storage capacity, and we're sitting today at about 400, a little bit north of 400 million barrels. So we've still got quite a ways, got about 100 million barrels downdraft before we deplete U.S. storage. Now, we have these same slides for all the other pad regions, including Pad 2 Cushing without Cushing and the total, and that's on our website, cEntellect.com. Please feel free if you want to look at all the pad regions. Let's transition out of the baseline case of what's operational and merchant, and let's start looking at these relationships. The relationship between WTI and price and volatility is actually negatively correlated. What happens is as the price increases, volatility decreases, and inverse. As price decreases, volatility increases. That's the natural relationship between price and volatility. The next slide I want to do is put in the context of stocks and price. So crude stocks, as they fall, price naturally goes up. So this is a historical relationship between Cushing barrels and price. So now we've got those relationships. I'm going to go back one. They're both negatively correlated. So now the question is, what happens to price volatility? And this is the best way to depict it. When stocks go down, we know that price goes up, but we know that volatility also goes up just as a function of stocks being down. But if we follow the price up, it in turn lowers the volatility per the previous chart. What happens is the price up, vol down is 4.3 times larger than the vol up from stocks being down. So you net those two, you end up with a vol down of about 3.3 magnitude. So said another way, stocks going down does increase volatility, but that volatility is overwhelmed by a factor of 4.3 to 1 as price goes up as a function of stocks down. So the net result is stocks down, vol is down. based upon these two offsetting relationships. Let's transition into scenarios. Stock scenarios can really be bucketed 4 ways. The first is low price and low stocks, and then we can transition to the right of high price and low stocks. And we can also look at high stocks and low price, high stocks and high price. Those are really the 4 generic scenarios. We're currently in the shaded scenario. We're currently in a high stocks, low price scenario. Notice that that occurs 37% of the time. This is the frequency scenarios. Now, if we go to the opposite corner, high price and low stocks occurs about 38% of the time. So those two combined are 75% of the time. The other 2 scenarios are what I call transitory scenarios. Those are the scenarios that we transition through to hit the main scenarios. So we're sitting here at 37%. So the question for the market is, are we going to transition to 38% going through the 12% low-low scenario, or are we going to transition from the 37% scenario to the 38% via the 13% scenario? The reason I say that is we get 2 dramatically different volatility implications as a result of that. Let's kind of close out with volatility. It's the same 4 scenarios. We're currently in the shaded about 80% volatility. If we transition into the other high frequency, which is the high price, low stocks of 61%, you can see that the 80% will go to 61%. That is the volatility down we previously described. But the wild card is, do we get to 61% by transitioning through the low stocks, low price, or do we get there by transitioning through the high stocks, high price scenario? You can see that one path takes us up to 98% vol before it drops us to 61. The second path takes us from 81, drops us to 52 before we step up to 61%. So from a trading perspective and from a volatility perspective and a risk management perspective, we're sitting at 80% vol. It'll be interesting as stocks continue to be depleted, which pattern we take, eventually arising at the next business cycle, which is 61%. Again, for all of the charts on operational versus metric for all the pad regions, plus a full table of where we're currently at, merchant stocks versus operational for each, please visit us at cEntellect.com.